Why US banks fear silver, what they're hiding, will shock you. Right now, while you're watching this, major American banks are sitting on 4.4 billion ounces of silver short positions. But here's the problem. The entire world only produces 800 million ounces per year. Silver just hit $92 an ounce, gold crossed $4,600, and the math doesn't add up. If silver keeps rising, these institutions can't cover their positions. They simply can't. So the question isn't if something breaks, the question is when, and what happens to your money when it does. Welcome to John Analyst. If you've been in business long enough, you know that the most dangerous risks are the ones nobody's talking about. Do me a favor, if you value having access to this kind of strategic intelligence before the mainstream catches on, go ahead and click that subscribe button right now. Think of it like getting tomorrow's newspaper today. And tell me in the comments, where are you watching this from? I'm curious to know how far this warning is reaching. Now, let's talk about what's really happening behind closed doors. The financial world is watching something unprecedented unfold in real time. Silver prices have surged to $92 per ounce, and behind these numbers, there's a crisis most people don't see coming. Analysts with keen eyes on commodity markets have begun connecting dots that reveal a dangerous pattern. The global silver production sits at approximately 800 million ounces per year. This is not a large number when considering industrial demand. Companies across multiple sectors are scrambling to secure silver supplies. Solar panel manufacturers need it, electric vehicle producers need it, electronics companies need it. The demand is relentless, but production remains limited. Now here is where the situation becomes critical. According to recent reports, major banks in the United States hold short positions on silver totaling 4.4 billion ounces. Let that number settle for a moment. Banks have bet against silver to the tune of 4.4 billion ounces. That is more than 5 years of global production. The mathematics here are not complicated. If silver prices continue their upward trajectory, these banks face a catastrophic problem. They must cover their short positions eventually. But where will they find 4.4 billion ounces of silver when the world only produces 800 million ounces annually? They cannot. Some investors are beginning to recognize this trap. They see what is coming. Many banks are already struggling to maintain adequate capital reserves. Financial stability reports show institutions operating with razor-thin margins. They are barely staying afloat under current conditions. Now add a silver price explosion to that equation. The scenario becomes grim very quickly. This is not the first time banks have found themselves on the wrong side of commodity positions. History has shown us what happens when financial institutions make over-leveraged bets. The consequences ripple through the entire economy. But this time, the exposure is in precious metals, assets that cannot be printed, assets that cannot be created out of thin air. Silver serves dual purposes in the modern economy. It functions as an industrial commodity. Critical manufacturing processes depend on it. At the same time, it serves as a monetary asset, a store of value. This dual nature makes the current situation even more volatile. Industrial users cannot simply stop buying silver if prices rise. Their production processes require it. Solar technology cannot function without silver paste for conductivity. Electric vehicles need silver for various electronic components. Medical equipment manufacturers use silver for its antimicrobial properties. The demand is structural, not speculative. Meanwhile, the supply side faces its own constraints. Mining operations cannot rapidly increase production. New mines take years to develop. Existing mines are already operating near capacity. There is no quick solution to a supply shortage. Banks that took short positions were betting on prices declining, or at minimum, remaining stable. That bet is now failing spectacularly. Every dollar increase in silver price represents billions in potential losses across these short positions. At $50 per ounce, the losses were manageable. At $75, concerning. At $92, potentially catastrophic. And silver shows no signs of stopping. The question facing financial analysts is not whether these banks will face difficulties. The question is how severe those difficulties will become. Can these institutions absorb the losses? Do they have sufficient capital reserves? What happens if multiple banks face simultaneous pressure? Some observers suggest this could trigger a broader banking crisis, not because of silver alone, but because of what silver exposure reveals about overall institutional health. If banks are this overextended on commodity positions, what else lurks on their balance sheets? The residential and commercial real estate markets show vulnerabilities. Loan portfolios carry significant risk. Corporate debt levels remain elevated. Banks facing losses on silver positions will have less capacity to weather problems in other areas. This creates a compounding effect. Financial contagion rarely announces itself with trumpets and fanfare. It usually begins quietly. A few institutions report unexpected losses. Stock prices decline. Credit markets tighten slightly. Then suddenly, the situation accelerates. What seemed manageable becomes critical within weeks or even days. The current silver situation has all the characteristics of an early warning system. Prices are screaming that something fundamental has shifted. The relationship between supply and demand is broken. The old assumptions no longer hold. Smart money is paying attention. Institutional investors are repositioning. Foreign central banks are moving reserves from dollars into gold. These are not random movements. These are strategic decisions based on cold analysis of what is coming. The American banking system stands at a crossroads. Silver prices reveal a truth that cannot be hidden much longer. The mathematics are unforgiving. The exposure is real. And time is running out for institutions caught on the wrong side of this trade. What happens next will determine the financial landscape for years to come. There exists a pattern in financial crises that most people miss until it is too late. In 2007, something called subprime mortgages began failing. The media barely covered it. Economists dismissed it as contained. Federal Reserve Chairman Ben Bernanke famously assured the public there was nothing to worry about. The problem was isolated to one small segment of the housing market. He was catastrophically wrong. 1 year later, the entire global financial system nearly collapsed. Today, a similar warning signal is flashing. But this time, it is not about mortgages. It is about something far more fundamental. It is about the creditworthiness of the United States government itself. Peter Schiff is an economist who predicted the 2008 crisis before it happened. Back in 2007, while others celebrated rising home prices, he was shorting the market. He saw what was coming. He understood the significance of subprime defaults when others did not. His 2013 book warned of America's coming bankruptcy. At the time, many called him premature, perhaps overly pessimistic. 12 years later, his warnings look prophetic. Schiff watches gold and silver prices the way a doctor monitors a patient's vital signs. And right now, those vital signs are alarming. Gold has more than doubled in just 12 months. Silver has nearly tripled in the same period. These are not normal market fluctuations. These are emergency signals. But what exactly are they signaling? The answer lies in understanding what gold and silver represent in the global financial system. When central banks around the world start buying gold instead of US Treasury bonds, they are making a statement. They are saying they no longer trust the dollar as a reliable store of value. They are preparing for something. And the numbers confirm this shift is happening. Foreign central banks have been accumulating gold reserves at unprecedented rates. Simultaneously, their holdings of US Treasury securities have been declining. This is a quiet revolution. No press conferences, no dramatic announcements, just steady, deliberate repositioning of trillions of dollars in assets. Why does this matter? For decades, the United States has enjoyed a unique privilege. The dollar serves as the world's reserve currency. This means other countries need dollars to conduct international trade. To get those dollars, they buy US Treasury bonds. This arrangement allows the American government to borrow astronomical sums at artificially low interest rates. It is a system that has funded the American lifestyle for generations. But that system is breaking down. The situation in Venezuela provides a crucial piece of this puzzle. The United States has become increasingly involved in Venezuelan affairs. The official explanation centers on democracy and human rights. The unstated reason involves oil. Venezuela possesses some of the world's largest oil reserves. Control over that oil means influence over global energy prices. More importantly, it means maintaining the petrodollar system. For half a century, oil has been priced in US dollars. Countries that want to buy oil need dollars. This creates artificial demand for the currency. It props up the dollar's value regardless of underlying economic fundamentals. Lose the petrodollar system, and the foundation of American financial dominance crumbles. This is why precious metals are surging. Savvy investors recognize that when gold and silver prices rise this dramatically, they are not really rising at all. The dollar is falling. The metals maintain their value. The currency loses purchasing power. What looks like a gold rally is actually a dollar crisis in slow motion, and it is accelerating. The parallels to 2007 are striking. Then, housing prices were the canary in the coal mine. Rising default rates signaled deeper problems in the credit system. Few understood the interconnections. Mortgage-backed securities seemed like isolated financial products. In reality, they were woven throughout the entire banking system. Today, Treasury bonds play a similar role. They are considered the safest assets in the world. They serve as collateral for countless transactions. They back pension funds, insurance companies, and bank reserves. If confidence in Treasury bonds erodes, the consequences cascade through every corner of the financial system. The difference between 2008 and now is scale. The mortgage crisis was large. $15 trillion in residential real estate value evaporated. Banks failed. Markets crashed. Governments intervened with trillions in bailouts and stimulus. This crisis involves the full faith and credit of the United States government. The numbers are not in the trillions. They are in the tens of trillions, perhaps hundreds of trillions when unfunded liabilities are included. There is no entity large enough to bail out the United States government. Peter Schiff believes the crisis will materialize within the next year, maybe sooner. The gold and silver price surges are not random. They reflect smart money moving to safety, moving away from dollar-denominated assets, moving away from promises and paper, moving toward real assets with intrinsic value. The Federal Reserve understands this. That is why interest rates are being cut despite persistent inflation. That is why the Trump administration has been pressuring for lower rates, not to stimulate economic growth, but to prevent banking system collapse, to keep over-leveraged institutions alive a little longer. The banks are not healthy, they're on life support, and the medication is running out. It was the greatest economic arrangement in human history for Americans. But every arrangement based on privilege rather than productivity eventually fails. The average American family lives in a house they could not afford under normal economic rules. They drive cars priced beyond their actual earning power. They consume food, entertainment, and goods at levels that seem disconnected from their productivity. This is not because Americans are uniquely prosperous. It is because the reserve currency status subsidizes their lifestyle. Think of it as a national credit card with no spending limit and no payment due date. Except the payment date is approaching. Foreign nations have grown tired of accepting dollars in exchange for real goods. They have accumulated trillions of dollars in reserves. Now they are asking a simple question. What can we actually buy with all these dollars? And more importantly, will these dollars hold their value? The answer to that second question is becoming increasingly clear. No. When the dollar loses its reserve status, the subsidies disappear. Americans will need to export real goods to pay for imports. But the manufacturing base has been gutted. The industrial capacity has been shipped overseas. The knowledge and skills have atrophied. Rebuilding takes decades. The adjustment will not be gradual. Consider a simple example. Today, a family of 4 goes to McDonald's. They order burgers, fries, and drinks. The bill comes to $60. The father pays with his credit card. He earns $50,000 per year. The meal represents about 3 hours of his labor. Now imagine the dollar loses half its purchasing power. That same meal suddenly costs $120, but his salary does not immediately double. Maybe it increases by 20% over 2 years as wages slowly adjust. Now that McDonald's meal represents 6 hours of labor, the family cannot afford to eat out as often. They cut back. They adjust their lifestyle downward. Multiply that across every purchase, every transaction, every aspect of daily life. Gasoline prices double, grocery bills triple, clothing costs surge. Electronics become luxury items again. Anything imported becomes prohibitively expensive for average earners. But here is where the situation becomes more complex. But every arrangement based on privilege rather than productivity eventually fails. The average American family lives in a house they could not afford under normal economic rules. They drive cars priced beyond their actual earning power. They consume food, entertainment, and goods at levels that seem disconnected from their productivity. This is not because Americans are uniquely prosperous. It is because the reserve currency status subsidizes their lifestyle. Think of it as a national credit card with no spending limit and no payment due date. Except the payment date is approaching. Foreign nations have grown tired of accepting dollars in exchange for real goods. They have accumulated trillions of dollars in reserves. Now they're asking a simple question. What can we actually buy with all these dollars? And more importantly, will these dollars hold their value? The answer to that second question is becoming increasingly clear. No. When the dollar loses its reserve status, the subsidies disappear. Americans will need to export real goods to pay for imports. But the manufacturing base has been gutted. The industrial capacity has been shipped overseas. The knowledge and skills have atrophied. Rebuilding takes decades. The adjustment will not be gradual. Consider a simple example. Today, a family of 4 goes to McDonald's. They order burgers, fries, and drinks. The bill comes to $60. The father pays with his credit card. He earns $50,000 per year. The meal represents about 3 hours of his labor. Now imagine the dollar loses half its purchasing power. That same meal suddenly costs $120, but his salary does not immediately double. Maybe it increases by 20% over 2 years as wages slowly adjust. Now that McDonald's meal represents 6 hours of labor, the family cannot afford to eat out as often. They cut back. They adjust their lifestyle downward. Multiply that across every purchase, every transaction, every aspect of daily life. Gasoline prices double. Grocery bills triple. Clothing costs surge. Electronics become luxury items again. Anything imported becomes prohibitively expensive for average earners. But here is where the situation becomes more complex. Not all prices rise equally. A haircut at a local barbershop will not double in price overnight. The barber is providing a local service. His costs increase, but not as dramatically as imported goods. So haircut prices might rise 30%, while shampoo prices triple. This creates a devastating trap for service workers. The barber's income rises modestly. Perhaps his prices increase by 30% to match his costs. But the products he needs to buy have tripled in price. His real purchasing power has been cut in half. He's working the same hours, serving the same customers, but becoming poorer every month. This pattern will repeat across the entire service economy. Teachers, nurses, retail workers, restaurant staff, anyone whose income is tied to local services rather than globally traded goods. Their wages will lag far behind price increases. The result is a rapid decline in living standards. Families that consider themselves middle class will find themselves struggling to afford basics. Retirement savings will evaporate in real terms. College funds will fall short. The dream of homeownership will drift further out of reach for younger generations. And this assumes a relatively orderly decline. If the dollar collapse accelerates into a crisis, the disruption becomes far more severe. Supply chains break down, store shelves empty, social unrest increases, political stability erodes. The banking system will face simultaneous pressure from multiple directions. Real estate loans will default as property values decline and buyers disappear. Commercial loans will fail as businesses struggle with collapsing consumer demand. Credit card debt will surge as families try to maintain their lifestyle on declining real incomes. Banks already weakened by silver short positions will face a cascading crisis. This is not speculation. This is simply what happens when reserve currency status ends. It has happened before to other nations. Britain experienced it after World War II. The pound sterling was once the world's reserve currency. Its loss triggered decades of economic decline and painful adjustment. The difference is scale. The dollar's dominance is far greater than the pound ever was. The adjustment will be correspondingly larger. Most Americans have no framework for understanding what is coming. They have lived their entire lives in a bubble of artificial prosperity. The bubble is about to pop, and very few are prepared for what happens next. The question is not whether this will happen. The mathematics guarantee it. The question is only timing and severity. When a ship is sinking, there are two types of people on board. Those who refuse to believe it is happening, and those who are already in the lifeboats. Right now, the financial ship is taking on water. Most passengers are still dancing on the deck. A small group is quietly moving toward the lifeboats. The question every person must answer is simple. Which group do you want to be in? The data speaks for itself. In the year 2000, gold traded at under $300 per ounce. Today, it stands above $4,600. That represents more than a 15-fold increase. Silver was under $5 per ounce at the turn of the millennium. Now it has crossed $92, an 18-fold return over the same period. Meanwhile, the Dow Jones Industrial Average has risen from 10,000 to nearly 50,000. On the surface, this looks impressive, a 5-fold increase. Financial media celebrates these stock market gains as proof of American economic strength. But look closer at the real numbers. If an investor put $10,000 into the Dow in 2000, they would have $50,000 today. If that same investor put $10,000 into gold, they would have $150,000. Into silver, $180,000. The stock market has underperformed precious metals by a factor of 3. More importantly, the Dow investment has lost more than half its value when measured in real money. The purchasing power of those stock gains has been inflated away. The numbers look bigger, but they buy less. This is the illusion of paper wealth. And the trend is accelerating. The question sophisticated investors are now asking is not whether to own precious metals. That decision has already been made. The question is how to maximize returns within the metals sector while the crisis unfolds. Physical gold and silver represent the conservative approach. They are stores of value, insurance against currency collapse. They will preserve wealth through the coming turmoil. Anyone holding dollars, bonds, or dollar-denominated assets should be converting a significant portion into physical metals immediately. But there is another opportunity that most people are missing. Gold mining companies and silver mining companies have tripled in value over the past year. That sounds impressive until you understand what it really means. These companies are now pulling metal out of the ground at roughly the same cost as last year. Perhaps costs have increased 10 or 15% due to inflation in fuel and labor. But they are selling that metal for 3 times the price. Think about what this means for profit margins. A mining company that was breaking even at $30 per ounce, silver is now selling at $92 per ounce. Their production costs might have risen to $35. They are now making $57 profit per ounce instead of 0. That is not a 300% increase in profits. That is infinite percentage growth from a break-even position. Yet these mining stocks have only tripled. They are actually cheaper now relative to their earnings than they were a year ago. Wall Street has not caught up to this reality yet. The algorithms and analysts are still using old models, old assumptions about metal prices. The opportunity window remains open, but it is closing. Senior mining companies with established operations and proven reserves offer relative safety. Mid-tier companies with growth potential provide balanced risk and reward. But the real asymmetric opportunity lies in junior mining companies. These are small operations. Exploration companies, development stage miners with deposits that were not economically viable at $30 silver or $1,500 gold. At current prices, those deposits are suddenly worth developing. Many of these companies are still trading as if metals were at old price levels. A junior miner with a proven silver deposit was worth $50 million when silver was $30 per ounce. That same deposit, same company, same management, is now fundamentally worth 3 times that amount. Yet the stock price has barely moved. This is where generational wealth can be built. But timing matters. As awareness spreads and mainstream investors flood into the sector, these valuations will correct rapidly. The window might be 6 months. It might be 12 months. It will not be 5 years. There's another dimension to this strategy that deserves attention: international diversification. The coming crisis is primarily an American crisis, a dollar crisis, a US banking crisis. Other countries will feel the effects, certainly. But nations with strong manufacturing bases, commodity exports, and responsible fiscal policies will fare far better. Foreign stocks, particularly in commodity-producing nations, have been generating exceptional returns. Some portfolios focused on foreign dividend-paying stocks have returned over 60% in a single year. This is not speculation or momentum trading. This is simply the mathematical result of being positioned in growing economies with sound currencies. The United States represents less than 5% of global population, but consumes far more than 5% of global resources. That imbalance cannot continue. As it corrects, wealth will flow away from America toward more productive economies. Investors who remain concentrated in U.S. assets will watch their wealth evaporate in real terms. Those who diversify internationally will preserve and grow their capital. But there is a practical problem emerging that few are discussing publicly. Physical silver supplies are becoming constrained. Mints and dealers are running low on inventory. The surge in demand is outpacing production and refining capacity. Within months, physical silver may become difficult to purchase at any price. The market is not prepared for what is coming. This is why immediate action matters. Waiting to see what happens next is not a strategy. By the time the crisis becomes obvious to everyone, the exits will be crowded. Premiums on physical metals will explode. Mining stocks will have already multiplied. The opportunity will have passed. The wealthy understand this. They are moving now, quietly, without fanfare or media attention. Central banks are buying gold by the hundreds of tons. Billionaires are diversifying out of dollars. Institutional money is flowing into hard assets. There is a race happening right now, a race to exit dollar-denominated assets before the crisis accelerates. Most Americans do not even know the race has started. The financial system cannot prevent what is coming. The mathematics are too far gone, debt levels too high, the imbalance is too extreme. No amount of Federal Reserve intervention or government stimulus can change the fundamental trajectory. But individuals can protect themselves. Those who act now will preserve their wealth through the crisis. More than that, they will position themselves to acquire undervalued assets when panic selling reaches its peak. They will have the resources to help family members who did not prepare. They will have the capital to rebuild when the crisis passes, because it will pass. Eventually, financial crises always do. The question is, who emerges on the other side with their wealth intact? And who emerges broke? The choice belongs to each individual. The information is available. The path is clear. The only question remaining is whether people will act on what they know, or wait until it is too late. History will remember this moment, the moment when the warning signs were obvious, when precious metals screamed their message to anyone willing to listen, when the mathematics showed clearly what was coming. Some will look back and realize they had the chance to protect themselves. They chose not to take it. Others will look back with gratitude that they acted when action still mattered. The ship is sinking, the lifeboats are still available, but they will not remain available forever.